Ladies and gentlemen, welcome to the Business Brew. I am your host, Bill Brewster. This episode features Ian Cassel. Ian has already been on the show. He has become a friend, and he is most known for small cap and microcap investing. He is the founder of MicroCapClub. I think Ian is a very good dude and somebody I enjoy talking to. So there has been some chatter about how small caps are cheap at the moment, and I figured that I would invite Ian on the show to get his take. And I think that we had a good conversation, and I hope you enjoy it. This episode is sponsored by Stratosphere.io. That's STRATOSPHERE.io. I pulled up Stratosphere just now. I was looking at one of Lawrence Hamtill's tweet, giving a shout out to @Heart of the Sea on Twitter. There's a underscore on between of and the in that handle. Anyway, Heart of the Sea put out a nice note on AutoZone. You can find it at canuckanalyst.substack.com and highlighted that it is a business and industry that has declining parts, but pricing is going up. And I said, you know what? I wonder what AutoZone's KPIs on Stratosphere.io would look like. And what do we have? We got segments and KPIs broken down into failure revenue, maintenance items revenue, discretionary revenue, auto parts stores revenue, other revenue, auto parts stores segment profit, and other segment profit. All right. So that's the kind of thing that you can find on Stratosphere. Should you sign up for the KPIs? If you choose to do that, use the promo code BREW for a 15% off code. I like Stratosphere. I think it's a great prosumer product. And I hope that some of y'all that have tried it out for free, that's FREE, have enjoyed it as well. Thank you to Braden and his team for sponsoring the show. And again, that's Stratosphere.io, STRATOSPHERE.io. And with that out of the way, none of this is investing advice. All of the information contained in this program is for educational and informational purposes only. Please consult your financial advisor before making financial decisions and do your own due diligence. Thanks for listening. Ladies and gentlemen, Ian Cassel's back. What's happening, man?
Not much, just everyday volatility.
Yeah, that is true. I right before this started, I was doing some cash management and merger arb, and you were on the video. Hopefully, I didn't buy the wrong security. How do you stay patient in illiquid stuff? Like this thing's gonna move away from me. I know it just from the order. How do you it takes a real level of discipline to not chase stuff, especially in the illiquid microcap land.
No, it really is, and especially when you're starting a new position and you want to get to a certain position size, and you want to remain disciplined, like you said, and you don't know if you're going to be able to get a full position or get a quarter of that position or a tenth of that position or 1% of that position until you put that order in.
Yeah.
And it is incredibly difficult. The nice thing about illiquid small, tilt my way towards the growthier end of the bucket is, if they execute, you have a long way to run. So you can't be afraid to average up, once the fundamentals, show that it's worthy of averaging up. And so that's one of the ways you get around that. It's just in small stuff, when it works and you find a management team that can execute, you're going to have other opportunities, and you can't be afraid just to take an offer, when you see execution.
Yeah, that makes sense. I guess my head tells me I should probably consider mitigating some of that risk by being smaller in the beginning. Right. And then as the execution, as trust builds, maybe buy more. And I suspect I'm going back to the episode with Bob Rabati when he said liquidity tends to manifest itself when earnings start to come through. Right. Then people actually want to buy, and then you can probably actually get to a full position when you want to.
Yeah. And especially with illiquid kind of smaller companies and illiquidity is in the eye of the beholder. You can have an illiquid large cap too, but for primarily talking about illiquid small businesses, generally, when the stock when management executes, the stock goes up, liquidity increases. So, and normally like the amount of dollar volume that trades after a stock goes up, doubles, triples, probably goes up 20 or 30x. So
Yeah.
you just have to be careful because, illiquidity doesn't bother you, but you just need to make sure you're going to be right. Because if you're right, liquidity takes care of itself because the liquidity will increase as the stock goes up.
Yeah, that's right. That's right.
Yeah.
Um, what's going on microcap land? What's going on in the microcap club? I'm getting a lot of emails. It seems like there's a lot of like posts. People are sharing what they own. It seems like the community is vibrant. How's that going after last year?
I think it's going pretty good. I mean, I'm kind of the latest thing is we have our summit kicking off September of this year. It's our first in-person summit, since 2019. So I'm excited about bringing the community together,
It's gonna be
in
fun.
person for the first time in 3 years. So I'm excited about that and excited about our speakers that we have. We have Connor Haley, Brian Bears, our good friend Jake Taylor, um, and so we have a good breadth of speakers and lineup that are going to be there, and also Ryan Pate from Expel. He's going to be there presenting. Might be a Q&A with me and him, but
Oh, for
you know,
real?
yeah. So he's going to be there as well. And so it's not too often you get to sit and listen to a CEO that was around a company when he started with it at 23 cents that took it to $100 per share, and now it's back down to 67, but still not bad. So
I still have time to sign up for this?
yeah, you do. I'm a big fan of scarcity in my investing and also like creating scarcity with this event too. But we kind of geared it towards 80 slots, 80
Yeah.
slots only. And the reason we did that, maybe to backtrack a little bit more, our event isn't sponsor supported. It isn't issuer supported, which means we have to front the full bill of the hotel, for having the event. And it's about $600-700 a person just costs to put a 2-day event on,
Yeah.
at a mid-level hotel in Chicago. So the price to do that, the registration fee to start out of the gate, and we started a little bit higher this year. Um, and so we basically started at 300, went to 4, 5, 6, and now it's at 700, which is basically our cost. And so I'll let a few more people register above the 80 mark. We sold out in about 48 hours,
Yeah.
but
All right.
yeah, I'm excited about it.
Well, I will follow up and pay you immediately because I that's a group I would love to listen to. That's a
Well, that's
very
what
cool group.
that's what I wanted to do. It's like I want to scratch the itch of different areas. Number one, you have a really top-notch emerging manager in Connor Haley. That's I think his name's well known throughout the investing world now. And has a long runway ahead of him. And then you have Brian Bears, who kind of wrote the book on kind of small stocks in the mid to late 90s and early 2000s when he started his fund, and now manages several billion. And I'll probably have some sort of Q&A or a roundtable with them, just talking about how they view microcaps, small caps, managing a fund, all that type of thing. And then I also wanted to have Jake, because I think his tool for Journalytic could be very applicable to any type of stock picker,
Yeah.
that he's created. And I wanted to have a platform for him to be able to showcase that because I do think it is valuable. And then last but not least, having a CEO founder that built a business, from 10 million to several hundred million that has 100x the stock price, just learning from that person,
Yeah,
what that
man.
takes to do.
That's
So,
sick. That's like a legit lineup.
yeah. Now, the main goal in our lineup of speakers every year is to make people think, why are these people presenting at a penny stock for? And that's the reaction I want. So that's the goal every year.
Yeah, well, it's I mean, obviously microcap is full of penny stocks and whatnot, but you look, I mean, I've talked to you for long enough. You're not looking for like you're looking for real businesses that no one else has found yet. So,
Yes. Yeah. No, absolutely.
I know that you found one recently and we don't need to talk about it, or you can if you want to. But I am curious to hear, like, how did you come across that name and management team, and like how did that how does an idea like that develop? Like, what's the germination of an Ian Cassel good idea that gets Ian Cassel excited to get out of bed in the morning? Because you see plenty of pitches on stuff that I'm sure you're like, no, 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 no. When do you get excited?
It's a good question. I might take two steps back to that because I think it's a question that we all kind of get asked, and at least I get asked is like, how do you find a great company? How do you find a microcap stock that's worthy of holding? And I think, to invert that is you have to first know what you're looking for, because what you're looking for, Bill, might be different than what I'm looking for, because the same flavors of investing in mid cap and large cap are also prevalent in microcap. I mean, you can find deep value stocks, growth, biotech, ONG, cyclicals. You can find all those flavors of investing down in microcap. You can find, you have people chasing 52-week lows, finding deep value at 52-week highs, chasing growth, and you have GARP in the middle. You have all those things, the same things. You know, and for me, what I like to do is just like let people know how I invest and what I'm looking for, because that will help them understand, why I identify and how I identify things and situations. Maybe a good place to start is, and this came up in my annual letter for the fund that I manage now, is I get asked when you look for companies, obviously the last 18 months has been a trialing period for microcap and small cap stocks. There's plenty of names that are down 60, 70, 80%. There's companies that were a billion market cap 2 years ago that are now sub 100 million. And so one of the questions that I think comes up is, during the last 18 months, I'm sure you've found a lot of new opportunities because the market's been volatile. The market's come down a lot. And I think generally that could be true. But for me, the way I invest, I kind of put things into two camps. You're either going after fallen angels or rising stars. I kind of put it into two buckets. And those fallen angels, those companies that were the billion-dollar market caps of yesteryear, that are now down 70, 80%, you can definitely find opportunities in them. I'm kind of biased against those opportunities. And I'm more geared towards trying to find the up and coming rising star, the new idea. And that could be a transformation from an old name, an old business. A new management team takes it over or something like that. But I'm generally geared more towards finding new things.
So a fallen angel that has like a true catalyst that people aren't appreciating yet would could be defined as a rising star to you,
Yes,
even
it
though
would
it's
still
still
be.
got that legacy stink.
Yeah, it could be. If there's a management turnover, and especially if there's some sort of potentially a rights offering or capital infusion from that new management team showing skin in the game as an inflection, that's kind of one of the screens that we do, as well as we don't necessarily screen for fundamentals from a screening standpoint, but we do screen for rights offerings, insider purchases, anything that
Oh, interesting.
triggers skin in the game at a transition point in a business, and that kind of lets us sit up a little bit more in the chair and pay attention to what's going on. Um,
Interesting. I've a non-gap would be proud of me. I do not look at an idea without reading the proxy first. I'm like, if I don't like the incentives, I don't even care what the idea is. Which I don't know if
oh
that's
no,
I may have gone too far, but
no. I mean, I think you're right in doing that. I mean, listen, like it's all about trying to find the management teams that you can trust. I mean, that's what building conviction is. I mean, if we want to think about, and we're all trying to do this. Listen, we're all trying to find and hold stocks that can go up 100, 500,000, 10,000%. That is the goal. And there's really kind of three primary ways to hold a multi-bagger. It's great to identify one. It's great to say, oh, I met that CEO 10 years ago, but unless you held it, it doesn't matter, unless you
yeah.
bought it and hold. And so there's kind of three primary ways you hold a multi-bagger. You have kind of the coffee can method, which I would kind of put as active coffee canning, which would be kind of a David Gardner approach where you put a lot of work in the front end, you position size small, and you take the selling part out of the equation. You're just trying to find things that you can buy and forget. You do front end work to it, and you just let it run, and you're fine with things going to zero.
I was
And
just
so that's
walking around thinking about him. Is that weird? That might be a little weird. But I was thinking the other thing that I like about his approach is he starts to double down on the winners. And when you look at the math of like how that strategy works, it works by riding the winners. Right? So
yeah,
he's betting as it's working.
and you have to have just obviously a long term time horizon with that type of approach, too. And it gets harder.
Also
Well,
helps
I'll
to
get
have
to the
subscription income.
Yeah, I mean, yes, it does. It helps subscription income, and it's a great way to have a newsletter too if you don't have to worry about telling people to sell.
Yeah.
But kind of the second way would be
But
sort
I
of a
think he
passive.
believes in it. I'm not trying to I'm not trying to
Oh
cut
no,
you
no.
off, but like I think it's funny. I was watching Twitter today, like something on Twitter today. The Daily Show had a clip, and the guy said, "Unless you're going to tell me your whole financial situation, I don't know that I want to hear your like ideas on a stock to pick." Right? It was sort of like he was talking about Kevin O'Leary and retail following him in, and I think that's an important insight. But I don't like. I mean, one of the reasons that I like David so much is like I think he believes in it, and then I think he thought, how can I create a business out of what I believe in? And then he like, like his version of anti-fragile is different than Buffett's, but they're both like, I mean, David's is probably a little more pro-cyclical because you get more cancellations when the market goes down. But I don't know. I like how he structured his life. Smart guy.
No, he is smart, but I think he does believe what he's doing, and I think his approach does work. Kind of growthier, larger cap end of the bucket to hold,
Yeah.
like that. You just have to be willing to go through contraction periods like the last 18 months when it doesn't matter if the business is performing. The multiple goes from 30 times sales to five. You just have to be able to weather that storm. It's a
Yeah,
tough
that's right.
storm.
And that is
Yeah,
not an easy storm.
it's not. It's
You
not.
know, I
It's
love
kind of
I love Buffett's the people like cite like Buffett, oh, you should want your stock to go down. Here's the other addendum to that. The stock is not going to collapse without bad stuff going on.
yeah,
like like they're
yeah,
not going to be
yeah.
executing and everything's going in the right direction and the stock falls through the bottom. That's just not how the world works.
Well, and in there's businesses too. I mean, they're such cash generative. I mean, if they were, they would be taking advantage of it.
Yeah, that's
You
right.
know, yeah, by eating themselves.
Yeah.
Um,
All right, I didn't
but
mean
so
to
it's
divert us. Sorry.
no, it's a good diversion. So you kind of have the David Gardner approach, and then you have sort of the true buy and forget coffee canning, where you put a little bit of money in, you put in such a little amount, doesn't really matter, and you forget it and throw them to the bed, and in 25 years you wake up at 100 bags and weren't even aware of it. But it
Yeah.
started off at such a small base, and that's kind of another way to hold things, and then sort of the last way is kind of the way that I do things and other people do as well. Is what I kind of call conviction investing, and that's really truly trying to understand and know the businesses better than most, and selling is still part of that strategy. And I think selling will always be part of the strategy in small emerging companies like microcaps. I think it's philosophical and cerebral and stoic to believe that you can find a bunch of $100 million market cap companies and coffee can them and forget them, but you'll be broke. Selling is part of the game.
Yeah.
And I think it's important not to fool yourself into wanting the world to be what you think it should be instead of how it really is. And that's a lot of these businesses, even the winners, they'll be held for a season or two, not for 30 years.
Yeah.
They'll work for 2 or 3 years and then they will stop working. Um, and it's just kind of what are the base rates. Look at the base rates of this industry. So as far as I'm concerned, I'm a conviction investor. I'm trying to find my intention with every purchase is to hold for 30 years. But the reality is very, very few of these small businesses deserve and earn that right to be held for 30 years.
Yeah. I one of the reasons I like talking to you, other than the fact that I think you're just like a great guy, is like I think you call balls and strikes like you see them, and I pinged you after some of the small is cheap stuff, and you came back and you were kind of like, well, I think it depends on what kind of investor you are, and I think that's indicative of the market. I think like high quality right now is not particularly cheap. I don't know that it ever deserves to get that cheap. I mean, if it's truly high quality. Um, but there's a lot of stuff out there that, I like Lumber Liquidators is trading at like half a tangible book, but you got to, management teams incentivized to grow operating income, and like you need an activist, and I don't know that it's worth the time. So it's just kind of interesting to
Yeah,
see the dichotomy.
no, it is. It's kind of how we started out. There's just so many different ways to invest. And I think that's one of the things, and you're probably the same way, Bill. It's like the longer you invest, the more you realize how many different ways there are to make money and how different we are. I mean, you can probably sit next to another value investor and yeah, from a distance, that fingerprint looks the same, but when you get up close, you'll see the differences,
Yeah.
and what you're really looking for and how you buy and how you sell and how you hold. the duration is a big part of it too.
Yeah.
So, and even during unfavorable periods, I mean, you have, a really unfavorable period for deep value, which I know you and Toby and Jake like to riff on, previously, maybe outside of the last 12 months, but then you still have a Michael Melby of Gate City Capital who was up like 1,000% in a deep value portfolio basket of stocks.
Yeah.
You still have these people that are crushing it even in that world, which always fascinates me. You know,
Yeah. I gotta meet that guy. Um, Evan Tyndall, he's, we'll
yeah,
see.
he's crushed it too.
Everybody has runs, and I think Evan would be the first to tell you probably never put together a run like he just did. But it's neat because he's objectively like a value guy. And it's nice to see him succeed because I think he's got a solid process. On value after hours, I think the only thing that I've taken a break from it. I think I'm still going to come on occasionally, but not regularly. One, because I don't have much left to say. But two, like it's just like one of those things. Value is either going to work or it's not. Like if the future is like the past, value is going to work, and if it's not, it's not.
Yeah.
I don't know. I don't know how much there is to say about it.
Well, and it's kind of like, how do you define value? And obviously, I think people today define value as just buying a business for less than it's worth,
Yeah.
compared to just pure Graham type of value, deep value investing. But yeah, I think go ahead.
No, I was just gonna say. I think the one thing that I think is it was written on MicroCapClub. The guy that wrote about how I'm almost certain it was written on MicroCapClub about how like capital is attracted to scarcity. Did you read that article?
Wait, which one was it?
I don't know, man. I'll send it to you after, and I'll link it in the show notes. I love the way that he
Okay.
said it, and I think it's definitely true. I think it's definitely true. That's how my mind works. I think it's definitely true in non-cash flow producing assets that scarcity wins. I have come to believe more and more that like durable businesses that are high quality actually are scarce and probably do deserve capital to come in over time. Like the incremental buyer, I kind of understand. Now I know, valuation matters, but I just wonder if there's not a, you know,
Yeah.
0.1% that actually is the outlier, that it doesn't actually matter all that much.
I mean, that's that, and I wrote on scarcity quite a bit in a few articles of Microcap Club because it's uh, probably one of the more fundamental things that I look for in the businesses that I invest in is truly trying to find those unique businesses, those one of one businesses that just happen to be publicly traded that are small, which are really hard to find. It's like, for example, I'm not interested in finding another UCAS company, another company there's 50 or 100 other publicly traded companies that are in that space, just marketing their product or service a little bit different,
Yeah.
trying to get share that way. It's like, you really want to find like those really unique one of one businesses that you combine scarcity with a tailwind of sentiment, consumer sentiment or consumer demand, whatever the case may be. Um, and that's how you want to find those Picassos where everybody's kind of going after those 10 pieces of artwork. And that's the biggest propellant of overvaluation and of price. I'm going to find something that's undervalued that can get overvalued,
Hmm.
and it doesn't mean that you're trying to play a pump and dump. It just means that you're trying to find great businesses early because there's great businesses always traded at premium because there's a scarcity of them.
Yeah.
There's just not many of them. So I think scarcity and also combining that growth and that barbell of growth and survival. And the survival part is the balance sheet part.
Yep.
Can it survive through a recession? And that's tough to find in small cap and microcap companies as well. Is really a balance sheet that can endure, and be aggressive, and a leader that can act with aggression with the capital that's on the balance sheet at the right time.
Hmm.
So it's a combination of all of those things, and the kind of frameworks that I try to find, at least for my type of investing, is combining that scarcity and survival, trying to find a business that can grow through a recession, which is a very tough hurdle, a balance sheet that can endure, intelligent fanatic leadership, and a valuation where you can at least see fundamentally that you can double your money in 3 years or a 25% CAGR, a fundamental, not a pump, not a story,
Yeah.
but fundamental growth in that business over 3, 4, 5 years.
Yeah, and the reason I think the reason that can get overvalued is how many other opportunities do you have out there? Like once people find that, that's the only one that they have, right? Like your
Yeah.
UCAS example. Okay, you could be the best, and I don't know where UCAS trades, but let's use book value as an imperfect proxy. By the time that you get to 1.1 times book, there's something else that's trading at zero point 0.6 book. You might as well just sell that and then buy the peer that's cheaper because they're not really all that different.
Mm-hmm.
Whereas like if you have something truly scarce, there is only one.
No, exactly. And it's really hard to find, but kind of going back, there's been a few episodes over my experience that kind of led me down the path of kind of the tailwind scarcity. And one of them was uh, the most pure way to kind of illustrate scarcity and tailwinds is there was a company, I think it was back in 2011. No, it's 2010. It was right before Facebook went public. And so it was the only publicly traded social media company at the time. It was a Latino social network called Kpasa, which then turned into Meet Me, which was actually acquired a couple years ago.
Hmm.
But back then, it was the only publicly traded social network. And I was kind of looking at this thinking there was brewing about Facebook going public and other social media assets going public. There's institutional interest, obviously, in this area. And so, I met the management team. I ended up buying some stock and it was around $1, $1.50. And sure enough, over the next 12 months leading up to the IPO of Facebook, the stock went from $1 to 14. You know,
Wow.
and it mainly was just institutions needed to get into this area, and there was only one way to play it at that point in time.
Interesting.
And that was more of a momentum move. As soon as some more assets went public, that stock went down and cratered back to $2 or $3. But there was this momentum type move where it kind of showed what scarcity can do when you have that fire hose pointed at like one thing,
Yeah.
what it can do.
Isn't that wild how the market works that way?
Yeah. And I'm not generally trying to find things like that anymore. You're trying to find kind of that similar dynamic, but in a high quality small business that's uniquely positioned.
Yeah. Why are so many well, I don't know that this is supported by statistics, but it's a feeling. Why are so many small caps like medical related or research, like medical research related? They need to go public to keep raising money or something like that?
Yes.
Yeah.
Yeah. I mean, I think predominantly, most of the IPOs, at least here in the US, seem to be life science companies that need to raise money to complete a phase 1, phase 2 trial, phase 3, whatever you name it. It's mainly towards they need to raise capital.
Yeah.
And when you get into other geographies like Australia, you have that. In Canada, you have that, but you actually have more breadth of different types of real businesses going public that are small, which is why it's been more important over the last 10 or 15 years to not be kind of landlocked here in the US, but to look north of the border, to look in Australia, look other places.
Yeah, the
Because
UK.
yeah, just because our kind of public market system for bringing small companies public is kind of somewhat broken. It's not broken in other areas,
Yeah.
and so if you can go to another place that has, it's English speaking, similar accounting rules, you have some comfort level that in that area, that's probably one of the biggest areas I've evolved to over the last, call it 10 years, is just looking outside the US for ideas, because you can find a company listed in Australia. I mean, listen, Expel, even though it was mainly a US company, it was listed in Canada.
Yeah.
There's one of our companies that we own is Australian listed, but it's a global business, so just because it's listed in that country doesn't mean it's whatever they sell or produce or service is just in that country. You can find global businesses.
Yeah. I wonder if part of me thinks that if they're smart enough to go about it that way, that's like a reasonably decent indication. I don't know. Maybe that thought can get you in trouble because there's probably a lot of schmucks that do the same. But that's smart. You're reducing the cost, reducing the reporting requirements. Like I can understand why there are valid reasons to go public that way. And it's like a smart capital allocation decision, I would think.
And it's, well, the shame of it is, you and I both being Americans, is it's actually easier to raise money in some of those other parts of the world than it is here in the US. And that's the shame of it,
Hmm.
given how robust our capital market systems are here, given the amount of people, the amount of money in the United States, when you can actually go and raise money easier, not because you found a bunch of lemmings that'll write you a check, but because it's actually structurally easier to raise money in Canada. It's structurally easier in Australia because when you go and raise money, they actually halt the stock for 2 weeks. They don't let market manipulators manipulate the stock down 20 or 30%,
Huh.
then the price at 30% lower, and all of a sudden you're doing a 60% in the whole capital raise like you do here in the US is what
Oh,
happens.
interesting.
Yeah. So there's these other mechanisms in these other parts of the world that just raise money just a lot. It's just a lot smarter than here in the US. If I'm a microcap company, and I want to go out and raise $10 million, that stock will probably be manipulated down 30% before it ever gets priced, just because people are aware of it, shorts are aware of it. It's funny how the whispers get out, and then all of a sudden, it just is a really bad, cost of capital by the time you actually raise equity, and that's a
Yeah.
shame. Like in Australia, as soon as you think about it, they halt the stock.
Huh.
Like, so there's no manipulation of the stock down to where you have to do an awful deal. You very rarely see deals in Australia actually have warrants either. It's just straight equity. It's usually like a slight discount to market, and it reopens and it starts trading again.
Huh.
And that's the way it should be over here. It's kind of ridiculous that the U.S. is the way it is when it comes to this. I think that would increase the amount of small companies going public and staying public and want to be public as small companies as well.
Oh, that's interesting. The other thing I mean, I saw a situation like that last year with a rights offering, and some people were pinging me, and they're like, "What do you think of this?" And the stock's going down. I don't know that I want to, participate in the rights offering because look at how weak the stock is, and it's like, guys, I don't know what to tell you, right? But it becomes this like self-fulfilling mechanism where I don't know, anyone that's got any weak hands or whatever gets kind of shaken out. And
It isn't.
it's not beneficial to the company raising or the current shareholders.
Yeah, no, and it's just it's a shame how the game is played here in the U.S. And a position that I own just went through this scenario just 2 months ago, where they started the process with a small cap bank, which everybody would know the name if I mentioned it, and they started the process. It was a 2 week process. Um, they said, "Yeah, we'll raise you this amount at this price." It wasn't signed to be underwritten at that point in time, but basically the last hour they said, "Oh, and by the way, we want to do it instead of a 12% discount, we want to do a 30% discount with a whole warrant," which would completely like destroy the cap table of the company.
Yeah.
Took out common shareholders to the woodshed. And the CEO said, "No, we're not going to do that." And in the meantime, the stock came down, while these discussions were happening. He had to cancel that contract with that bank, sign up another one, and then it got priced 12% below that. And it looks like a bad deal when there's all these crazy shenanigans going on behind the scenes, of people positioning, people shorting, people, whatever, manipulating. And it just increases the cost of capital, for the company tremendously. It's kind of a broken system we have for raising capitals as microcap companies here.
Dude, 12 to 30% discount is a big difference.
Yeah, and the CEO, when I talked to him, he asked the lead banker there of that company, like he said, how many CEOs would say, "Okay, let's do it," and he said 90%. So
Wow.
90% would be like, "Yeah, we'll take the money." It
Huh.
doesn't matter if it would take it from 50 million shares out to 100 million, doing like just an awful deal that planted that stock lower probably for a year.
Yeah.
They would have still done it to get the capital because they're up against the wall. And so it's a shame that's the way it has to be. And so, like I said, like in Canada, like their ability to raise 10 million in an overnight at the market, or Australia, where they just halt the stock, so there's no manipulation, so you don't have to worry about that. It's just a smarter way to go about raising capital.
I'll tell you what's crazy about that is, we've got those problems here, and meanwhile, and some of the SPACs that got floated and the crypto stuff, like it's wild how you can get certain things done, but then other things that maybe legit you can't.
Yeah, I mean, and it depends if it's in vogue or not. Like, listen, everybody was, not everybody, but a lot of people were okay with SPACs as long as they were going up, but
Yeah.
then when things start going down, you start looking into the contracts of those SPACs, and you understand, like, hey, there's founder level shares, there's sponsor level shares, there's sponsor of the sponsor level shares, and then there's 20 million warrant overhang at a strike of 1150, and you're wondering why the stock doesn't go anywhere.
Yeah.
Just like everyone has cheap stock, and there's a boatload of warrants as you're stealing. It's like, and you're wondering why these stocks don't go up or go anywhere, because it takes, on top of that, 95% of the SPACs are seeking unprofitable businesses.
Yeah.
So it's just the spiral. And so the ones that have worked have been companies that are actually profitable that went public. But even then, it takes 2 or 3 years for those stocks to actually get above like $10 or $15 per share because of all that really low price stock that was placed with founders, sponsors, the warrant overhang that has to be eaten through.
Yeah.
So it just takes 2 or 3 years.
Yeah, you get a lot of dilution on the com,
Yeah,
right?
yeah. Usually the ones that work in the SPAC world, they're profitable businesses that they act quickly to clean up the cap table. They'll do like a conversion with the warrant overhang. Be like, all right, let's just get rid of these things. Let's give you a 0.1 ratio or a 0.25 ratio. Convert that into common just to get rid of it, to clean it up. So you
Oh,
see that,
interesting.
yeah, and that can usually spearhead the equity being able to go higher quicker.
So what? They'll go to the warrant holders and say, you know, if we remove 3 warrants, we'll guarantee you $1 today, common stock, and you're removing some of the overhang. The warrant holder wants to do it because they're guaranteed to get some money instead of sort of holding potentially a worthless option, and then the analysis gets a lot easier. Is that what you're
It
saying?
is, because a lot of these companies, as an example, like they'll have 20, 30 million shares outstanding, but then there's like another 12 to 15 million warrants right
Yeah,
there
yeah,
too
that's
at
right.
11. So they'll go to those people and be like, let's convert your warrant into point 0.2 common.
Huh?
And so you'll take the dilution from 13 million down to 2.5,
Yeah,
completely clean. It's cleaned up. Um, and then you have a cleaned up cap table that can start to work.
yeah,
But even like the ones, of the 500 SPACs that have gone public, there's like 26 that are above the price of 10. If you look, you'll see that commonality of, probably 90% of them were profitable. It's UTZ, UTZ, a company like that was profitable, name brand, that actually just happened to go public as a SPAC that, was a fundamentally good business that also did these conversions, either through cashless exercise of the warrants or through conversions into equity that then allowed the equity to finally go up.
yeah. Huh?
I think there's a middle ground there. Once somebody actually has the capital or wherewithal. I don't think SPAC's a bad way to go public, but I think they just need to get rid. There needs to be one less standard deviation of sliminess,
Yeah,
and then it can maybe.
yeah. I think that's right. Yeah, I've come to appreciate the validity of SPACs. I used to think that they were completely a waste, and now, or not a waste, but like bad for shareholder or minority shareholders. Now I think like any IPO, they're probably not great, but I think there's maybe more merit in them that I used to appreciate.
I'm even all that just said. It's like it's a place that I kind of like to look sometimes at as well, just because it's so hated of a vehicle of an area, and you're still going to find some decent businesses that decide to go public simply because of that business owner that's merging with that SPAC just doesn't have the relationships or wherewithal to know that they could have gone public or raised capital in other ways,
Yeah.
and that's not always a bad, awful thing. It's just the way it is sometimes. So it's good to keep your eyes open.
But then you're kind of closer to the fallen angel category, right?
Yes. Yeah. Yeah. You just have to be
Although a SPAX
usually,
is maybe a fallen devil.
yeah, I mean, usually these things just kind of like they pop up because in the first few months there's barely any float to the equities, so you see these things YOLO, like a Lunar LUNR that did it 2 3 weeks ago from 10 to 70.
Oh, I didn't
It's
see that.
because, and so what happens is, especially now,
Man, owning the
you know,
warrants on that would be nice.
they don't react. as much as you would think.
It makes sense because
Yeah.
somebody's like, this doesn't make sense, right?
Yes. Yeah. They don't like the warrants on that. Like the equity goes 10 to 70. The warrants on that I think went from 60 cents to $1.
Oh, interesting. Okay, the market's smart.
Yeah. They know, and they know if they wait 5 days, the equity will be back down to 15.
Yeah.
Yeah. So, um, but yeah, but it's interesting right now for the SPAC world. There's a lot of these SPACs that call it YOLO in the first 2 or 3 weeks simply because there's no float, because everybody that invested in that SPAC originally when they raised money, whether it's $100 or $500 million type SPAC, those investors are in it. And then they're brought in the deal. They vote yes or no if they want to remain in the deal. 95% of these investors are just pulling their capital out,
Yeah.
and so what's left is the float of the stock. And so you'll have like these really, really low float situations, as you know, that traders like to pile into because make momentum moves.
Yeah.
And that's why you're seeing a lot of these momentum moves in stocks that just de-SPACed, is because there's just no float there and they can
Huh.
be manipulated.
How new is this? Have you seen this in the past? Like, is this this tight float trading deal? Is this something that is as old as time, but we're all paying attention to for the first time, or is this like a new phenomenon?
I think the low float illiquidity aspect has always been there, but I think it's been, I don't know, I'll use this term worse or better, whatever you want to call it, but it's definitely increased due to the kind of the meme stock episode, and now this, it just seems to be happening more.
Yeah.
So I think it has increased. Um, what's interesting is when you find companies that actually take advantage of it, and they're actually smart with taking advantage of it. Like
Yeah. Have an at the
they'll have
market or whatever, and they'll just be
yeah,
issuing shares. It's genius.
yes, yeah, yeah. We saw that a couple of times in the last 3 or 4 years, where it was a company with really no fundamental business that was able to raise $1 billion in an ATM over the course of a year or two, and all of a sudden they've been able to raise their way into a fundamental business model.
Yeah.
It's crazy.
I don't even hate the companies in that case, right? Like, I mean, it's one of those don't hate the player, hate the game type things.
Yeah, yeah, and some of them, it's not like they knowingly went into the situation saying, "Hey, this stock's gonna all of a sudden be, all these traders going to funnel into this stock, and I'm going to sell all this equity into them." Like a lot of
Yeah.
this, it just happens. Like, and I've had a few positions where it kind of hit a week, 2 weeks, 3 weeks of these traders just piling in. It's like not like the CEO knew anything about it. All of a sudden, it just erupts. You
Huh.
know, and that's why it's smart, unlike 3 4 years ago, for some of these companies to have an ETN in place, and just in case something stupid like that happens, that they can take advantage of it and put some cash in the balance sheet.
Yeah, it's almost it's weird, but if I was an advisor to a company, like I mean, like you see it with Bed Bath and Beyond right now, but there's a sophisticated party, I believe, involved in that. But I would say I'd just be like, just get an at the money registered or whatever, just in case, because who the heck
Yeah,
knows?
yeah, a lot of companies are doing that now, and that's one of the things that's changed quite dramatically in microcap. Is they were very equity lines, or ATMs, were frowned upon quite gravely like 4 or 5 years ago.
Huh?
Um,
Why? Because you could just like throw shares out into the market whenever.
you could, and the structure, the SEC came down on them pretty hard too. But back then, like the company could like hit the bid,
Yeah.
where the ATMs of today, you can only sell at the offer. You can only be 10% of on the offer. It's like it has to be an offer taken for them to sell, and even at that point, they can only be 10% of the sell volume.
Huh.
In a
Okay.
in a given day. So which makes sense. It doesn't impact the shares. If it's going to go higher, it's going to go higher regardless of them selling 10%.
Yep.
The volume into it. So they're much better than they used to be, and so you're seeing a lot more companies at least have them in place for that very reason, because it is a lower cost of capital. I just had a conversation literally this weekend with a company that put one in place for that very reason. It's also a way to block off shares to an institution, uh, quite easily and effectively without paying commissions. So the commission on an ATM line is 3% versus 7 or 8% when you're doing a standard, deal if you wanted to raise
Oh,
capital.
interesting.
You know, so like you approach microcap A and they have an equity line, and you want to take a position, and you're You want to buy $5 million of the stock. I mean, you can just set up an account with whoever the ATM line's through, and they'll block off the stock right to you, and the company gets a deal done at the market at a low commission. And the
Oh,
cost of capital is
that's
low.
interesting.
Yeah. So you see kind of it being used in that way as well today.
Huh. I don't have the size to approach companies about block trades, or I am messing in companies that are too big to approach them. Either way, it's not something I've been familiar with.
You focus on companies that are just too fundamentally pure. They don't have to worry about such
That's correct.
shenanigans as
Yes,
ATM.
yes,
So
that's right. The Puritans of the market,
yes,
despite by the non-Puritan side of the market was the MSO idea that did not go so hot. But oh well, it's not over. We'll see how it goes. But
but it is interesting, and you probably see it in your positions too. And I was just journaling about this the other day, but there's usually one or two instances a year where something you own gets to a price, lower, that it's a no-brainer buy. And especially in microcap, you find it because of the illiquidity profile of these companies. And it never ceases to amaze me. Like and you just have to have conviction because usually that point in time where it's a buy might be minutes, hours, days, not a month or 2 months.
yeah.
And it's crazy how quickly it happens and just stupid stuff happens. If you have time for a crazy story, I'll tell you
Oh
one.
yeah,
Actually,
man.
it just happened in February. So one of our long investments that we're in, it trades in Australia. I kind of mentioned it earlier in the conversation. There's a company called Cogstate, and this is nobody should run and buy this stock by any stretch of your imagination. This is just used for illustrative purposes. That's the
That's
best
right.
way.
And entertainment and
Um,
information. That's it.
yeah, yeah. So Cogstate is a business that we've owned for about 3 years, right before COVID, and kind of combining that tailwinds and scarcity. So, the business itself, it is a technology provider to clinical trials, specifically for central nervous system disease areas. They do cognitive assessments,
Okay.
and so they're predominantly a pure play onto Alzheimer's R&D and commercialization, which is going to
Okay.
be a
And
hot area.
and and when a company gets an approval, I'm sure they have to use Cogstate's equipment or whatever that was used in testing in perpetuity, more or less, right?
They don't have to. So the core business of Cogstate is actually giving their technology and their services to clinical trials, those companies that are running trials on these drugs. And Cogstate's digital assessments, are basically telling that pharmaceutical company, is the cognitive decline increasing, decreasing?
Okay.
And that's what their cognitive assessments are doing. And they also provide services to those mainly Alzheimer's clinical trials.
And they
And so
don't get
that
the
business,
long tail after?
well, hold on.
Okay.
And so the three biggest spenders in Alzheimer's disease really are Biogen and Eisai, Eli Lilly, Roche is right up there as well. And so those are kind of the three behemoths that have late stage assets that could be commercialized over the next, call it 1 or 2 years.
Okay.
It'd be the first time like it. And so there's been a lot of movement in this space. And so those are the biggest spenders as well. So Eisai, their drug is going to be up for full approval, be the first one, 30 years for Alzheimer's. Will be up for full approval. I think the PDUFA date is sometime in July 7th, maybe. And that'll be
Huh.
an exciting time. Eisai owns 10% of Cogstate, and they
Oh.
also partnered with Cogstate to be their global distributor of their cognitive assessments.
Oh,
So,
interesting.
so to your point, they started rolling out their cognitive assessments, a direct to consumer kind of app, iPad, into Asia already, and they're going to start probably doing that into the U.S. upon an approval, hopefully later this year in the U.S.
Huh.
But a bulk of the 95% of the revenues of Cogstate is just supplying that technology to clinical trials. And so that's a $45 million business. There's about 10 million in earnings, great balance sheet, blah, blah, blah. It's probably the best pure play way to play this Alzheimer's R&D commercialization boom that's probably going to happen over the next 10 years, because
Huh.
they're so well positioned. So getting to my story of what happened in February. the company is likely going to be, my guess is acquired in the next 2 years because it's such a unique niche business in this area. And if another CRO or if somebody else wants to get a foothold in this space, they would kind of have to buy Cogstate. And so what happened was early February, while I was on vacation, the stock started getting bid up aggressively in the market.
Oh wow, yeah.
And you'll
I
see it in
can
the
see
volume.
this.
Yes. So it started getting bid up aggressively, which was just kind of a weird time for it to get bid up aggressively. And it they were just inching it up like 5-6 cents a day.
Yeah,
Again,
wow.
the stock usually trades 100,000 shares a day. It started trading 1 million to 1.5 million
Yeah,
shares a
man,
day.
it looks like it peaked at like 6 million or something like that. Maybe 5.572.
Yeah,
Wow.
so they took it up to 240, and then all of a sudden the next day it dropped from 240 to 190
Yeah, that's
on like
crazy.
on 2.5 million shares. The stock the next day opens at 160. So from 240, so it started at 190. They bid it up to 240. It
Oh
drops
yeah,
to
sure
190.
enough.
It drops to 160. The stock is halted in Australia for
Hmm.
2 days. The company then, because they're waiting for the company to let them know what's going on or if they know of anything that would be manipulating the stock price. It takes 2 days. The company finally files with the Australian Stock Exchange that they were in discussions to be acquired.
Oh
Um,
wow.
so some group had, with insider knowledge, bid up the stock, bought about 10 or 15 million shares during that run up. The company announced that on February 18th, the discussion stopped. They couldn't come to terms on price, and that person just dumped it,
Yeah.
all the stock they just bought. And they drilled it straight down through the ground and it hit 113
Yeah.
per share.
Yeah, it's wild. The chart looks like it's like literally straight down.
Yeah, it literally went straight down. And so at 113, it's trading at like 10 times EBIT, like on a very scarce, unique business.
Yeah.
That it's just being it's a forced seller, right?
Yeah.
And
It's
I'm on
crazy that they
vacation.
did that. What a great way to get caught.
Yeah, I'm on vacation. I'm just like, oh my goodness, like, it's great. I'm trying to pay attention to my vacation. So anyway, um, the company finally came out. They put a buyback in place. They said that insiders are going to start buying. The stock's now like 150, 160. But it was just one of the craziest things I've seen probably in 10 years where you had this like obvious insider, not insider, it wasn't an insider, but somebody with insider knowledge was buying aggressively and then just dumped it all over 3 days.
Yeah.
Just really planning the stock. And it's one of those crazy things that it happens from time to time. I haven't seen anything like this, but to the point of usually once a year, you have the opportunity to buy oftentimes one of the companies in your portfolio where it just gets something just happens and you're able to but again, but just like with this, your reaction time was like 1 or 2 days. It's not like you had a month to think about it.
Yeah.
It's always the hardest at the bottom because you're like, well, what's going on? Blah, blah, blah,
Yeah,
you
that's
never want to
right.
do you always want to do the right thing. You end up doing the wrong thing at the wrong time. So the right thing at the right time.
How much lower can it go? Maybe I can get
Yeah,
like super greedy on this.
yeah,
Yeah.
exactly. But that was an interesting February, and so it was for our investors. It was a decent sized position. So it was a kind of a fun story to retell in a note to our investors that I sent out a couple of weeks ago. Just saying, hey, this is the volatility of microcaps.
Yeah.
Get ready for your NAV statement end of February. It's gonna be ugly. So just
Yeah, that's right. When my Sharp ratio doesn't look good, this is part
yeah,
of why.
yeah, exactly.
Uh,
Um, but once again, that's not an endorsement to buy this here or buy it there or ever buy this company. It was just I like to provide at least one real world example and not me talking
yeah.
stories about the past. So
Yeah. No, that's super interesting. I mean, it looks like, yeah, they've created a lot of enterprise value over the last 4 years. Is it going to, what about dementia? Is that part of Alzheimer's research or,
yeah,
yeah?
yeah, they're pretty much in central nervous system diseases, which could be Parkinson's, could be other rare diseases, but it's mainly Alzheimer's. I think Alzheimer's would probably be 70% of their core business, but that's mainly because of some of these late stage Alzheimer's assets being in phase 3 trials, which is more revenue to Cogstate than a phase 1 or phase 2 trial.
Huh.
So it's but these trials take 4 or 5 years to run.
Well, I hope it works, man. That's super encouraging. It makes me feel a little sad for my grandma. She's probably 15 years early in her aging process, but Maybe
Yeah,
maybe only 10, maybe 5. Who the hell knows? But dementia's tough to watch, man. It's
it's
sad.
awful.
Yeah.
It's it is awful. I mean, I think it's one of the. I'm trying to remember the statistic. Is it the only one in the top 10 causes of death that doesn't actually have a drug that helps, basically? And
Oh,
that's the
interesting.
opportunity you see from the big pharma companies. You have when Eli Lilly, they have a phase 3 asset that's going to read out in the summertime. When Eli Lilly, which is, I don't know, 300 billion market cap, maybe 200, 300 billion, when they announce anything positive about this one drug, it can move that stock 10%.
Yeah.
That's a big move that shows how important even any type of drug in this space is. Like when Biogen announces anything about um, lecanemab, hopefully getting approval, or Eisai, who's the partner with them, their stocks can like double. And they're
Yeah.
a 30, 40 billion market cap. I mean, these are big opportunities, drugs that could do 15, 20 billion a year.
Yeah.
That can move a needle for companies like that. So it's a big opportunity set. And usually whether it's MS or any other disease state, once kind of the first approval happens in that area, there's just a flood of R and
Yeah, the
D because
waterfall
attacks that
opens.
space. Yeah, and so that just increases R&D spend, clinical trials. That's the tailwind to Cogstate. There's going to be like a bunch more trials that are going to be hitting, around an approval by those companies because they need to run more clinical trials to hit different geographical areas and different indications and stuff like that. They immediately just run, sprinting. They just launch clinical trials. So it's an interesting time.
Yeah.
But Alzheimer's is awful. It's brutal.
Well, I think one of the things that's fun about stock picking, and I say a lot, like I should probably just index, but, um, the thing that I love about the game is the research of it, right? And finding like, something like Cogstate or whatever, when I went down my deep, I did some work on Dish. Like I like telecom. I think it's interesting. I didn't, I don't own Dish or anything, but the research process was fun, right? Like I learned
Yeah.
some stuff about the world and I'm excited to see where it may go. And I don't have a strong view on whether it goes one way or the other, but, uh, at least when it comes to Cogstate, I really hope that there's a lot of progress because, we're all living a lot longer and the mind has a finite life to it. So it would be nice if we don't all live long enough to go like to lose our minds. That would be a bad outcome.
Yes. No, 100%. Well, and to your point about it is, it's so fun. Like I would say probably 50% of our portfolio is in kind of medical technology. And I think the reason why we've ended up being so focused kind of on healthcare isn't because I thought out wanting to be focused in healthcare. It kind of just had the qualitative elements that inflected with the microcap opportunity set where you can still find small emerging companies that have a moat because of their IP, because the product or service that they're pushing through a trial or that they're commercializing that has really good gross margins, have amazing operating margins that can sustain 30-40% organic growth over 5 years or more. And it's in an area like healthcare where you don't necessarily have to worry about, GDP dipping, 100 basis points or
Yeah.
whatever. People are still going to be spending in that area if that drug or service is efficacious to that population. So it's an area we just ended up kind of finding ourselves in because of the qualitative attributes that are in kind of that area that we have. And there's a lot, like you said, there's a lot of companies still going public in medical technology. And so it is an area that you see a lot more companies going public in healthcare as small public companies in the US too.
Yeah. I looked at Maxite. I thought that was interesting. I like the subscription sort of aspect to a lot of these once they get,
Hmm.
embedded in the process. It's a nice recurring revenue stream.
Yeah,
It's got a
no,
lot of the
definitely.
characteristics like at scale, theoretically they have a lot of the characteristics of really good businesses, right? So the potential to win seems quite high. Obviously, a
Yeah,
lot of the times market knows that, right? Like we've talked about ClearPoint, that never seems to get like screamingly cheap. But if they can pull off what they can pull off, it'll be good for society and shareholders. It'd be great.
100%. And yeah, ClearPoint's a good example too. It's kind of has a cult like following, and rightly so. It's doing a lot of good in the world, and hopefully will continue to do well. And so like the focus there is just what valuation should I pay? You
Yeah,
know,
that's
so
right.
and I posted that on MicroCapClub about it too. One of our other members kind of made the point that, everybody's waiting for a clear point to grow 50% per year, but it very well could just be a company that grows, 20% for 10 years,
Yeah.
and that's okay, and so, but it just means in the interim, it's like whether the stock should trade at 5 or 15, depends on who wants to buy or sell 100,000 shares.
Yeah, I mean, if it can compound for that long at that rate, the probability that you overpay is seems low to me, right? Especially if margins stay where they are and they're likely to inflect higher. So, but that's an if.
It's a tough spot. I think maybe the biggest difference between one of the big differences in microcap from now versus maybe 24 months ago is if you're a company that, and I say low growth, and I mentioned 20%, like that's decent growth, obviously. But if you're kind of a lower organic growth company that is losing money, your stock and nobody knows what to do with it. It's really kind of that gray area I found is it can be very, the stock could be manipulated a lot lower or higher. It's like you just don't know where it trades anymore. Where before everybody was just kind of running out their most bullish scenarios and it was an excuse to buy it. Where now it's just like, yeah, but they're still burning, X, Y, and Z.
Yeah.
Maybe they get to break even next year or the year after. That's one of the biggest areas that have changed kind of in microcap is the willingness to endure through, a 20% grower that continues to bleed money.
Yeah.
Yeah.
Yeah. I think, where we were in the market cycle, I think clearly we're going to look back at a lot of those valuations and say that that was silly what people paid. But I'm not convinced that some of the valuations aren't going to make sense, over the long term. I just don't know which ones. But
Hmm.
I do think that part of what gets lost in the never sell or looking back at the Nifty 50 and, they did eventually outperform. I mean, the drawdowns you got to live through are nuts. So
Yeah.
to your point, like if you're really going to coffee can something, you got to be able to emotionally take being down, and that's like a lot easier to read about than to live.
It is. It's like the volatility. Like, so, when I was building my capital, like when I was in my 20s and then became a prime full-time investor, I was in two, three, four stocks, right? And so today, managing a fund for outside investors, I'm in four, five, six.
Yeah,
That's
that's
very concentrated.
yeah,
And I tell people when they've come on as well, I'm just like, listen, if we are successful, there's going to be a position that becomes 60% of this portfolio, and we're not going to sell it just because it grew out of our mandate of being microcap. That's stupid.
yeah,
If the fundamentals are underlying the valuation of that business and the thing is 50% of the portfolio, like we're not going to sell it just for the sake of selling it. That's what success looks like is one or two positions dominating this portfolio. But you also have to understand that like when that occurs, the portfolio will zig when the market zags, because it'll go in line with that largest position. Like right now, I'll tell you, like you'll be horrified by this. Well, you won't be, but other people will. It's like we have a 45% position right now because
oh
it's gone
wow,
up.
yeah, good for you.
And so one of the things that has to be articulated when you have investors, because I'm used to it, but you have other people that are living through that volatility with me now,
Yeah,
is like, listen, when this one stock goes up 10%, it's like a 5% position doubling.
yeah,
When this
that's right.
position go, when this position goes down 10%, it's like a 5% position going to zero.
Yeah,
And so you just have to be willing to understand this portfolio is going to zig, and when the market zags, we're going to look like heroes when the market goes down, and we're going to look like idiots when the market goes up, because a lot of you're kind of living with the volatility of that large position over time.
so when you have a position that's that size, are you like focused on quarterly numbers, or are you more focused on, what are they? I'm thinking of when I was talking to Adam Wyden, and he's like, I'm thinking about what are they doing to position themselves for the next 5 years and building out the bench and setting up. Like, are you worried about missing in a given quarter, or are you like more worried about is the underlying structural thesis right, and are they doing the right things to grow? Because a position that big, to your point, I mean, if it's 20% overvalued, people are going to feel it when it gets down to
Yeah,
fair value.
yeah, and that was one again that so that was one that during 2022 kind of had a 50% drawdown at one point, and we got aggressive and bought it more. and then it, just like a lot of things, doubling off the lows of 22, which a lot of things did. But yeah, I mean, to your point, I mean, I'm mainly trying to always look 3 years out. And there's a lot of puzzle pieces that go into that question that you just asked. Like in this case of this one, I can't say generally what to do, but in case of this one, this is still a very underfollowed, uninstitutionalized company. It's done well, but it trades very illiquid. Um, and there's one analyst that covers it, and they weren't even in the last conference call, even though it's the fastest growing thing in that space.
Huh.
So institutional discovery still hasn't even occurred,
Yeah.
and it's still only trading at the comp peer multiple.
Huh.
Even so I do take all of those puzzle pieces together when I think about the position size, what the future looks like. But no, I mean that one, it's kind of hard to speak generally about how to
But
hold
that
a
makes
45%
sense.
position.
So the probability, I mean, if it's trading in line with comps, there's some reasonable argument on a DCF. It's underfollowed institutionally. The probability that this is egregiously overvalued is probably fairly low, given where it's probably going. Right? Is maybe the way
Correct.
you're thinking
Yeah.
about it.
Yeah. I'm a big fan of getting in things before the first wave of discovery occurs. And this hasn't had that first wave discovery.
Hmm.
The first wave of discovery is powerful because it's a new story that institutions have never heard before that don't have a reason not to buy it.
Yeah.
And so that first initial discovery move that can be 100 to 1,000% higher, it can occur because, it's a new thing. Kind of go back to the rising stars kind of aspect of my investing philosophy. Um,
Yeah.
and so that gets it's pretty exciting that this company's done well. It's probably the fastest growing in their area in that industry, and there's still only one analyst that covers it. It's 50% insider, board controlled. And they're just crushing it. And I know it's only a matter of time until other institutions, other analysts bring on coverage,
Yeah.
until people want to participate in this thing that they need to participate in because it's the fastest growing thing in their area.
Yeah. That's neat. And you trust the management team,
Yeah,
obviously. Yeah. That's exciting, man.
that's the part of it that usually the position size also correlates with the amount of trust I have, with the management team itself. It's almost less about risk reward than it is about how much do I trust these folks. I mean, I think conviction, I'm a conviction investor. So conviction is a lot like building the relationship with anybody, whether it's your spouse, whether it's a friend, or whatever it is. It can only be built over time. And so like this position with this company, I've known the CEO for several years. And just like with any relationship, your conviction grows the most in the bad times
Yeah.
because you get to see how they react, good or bad. And you know whether you should be doubling down or just cutting loose.
Hmm.
Um, and in this circumstance, they've proven to be winners, in the worst of times.
Yeah. Isn't it funny how you find out who people are when the chips are actually down,
Yeah.
Everybody can get along when things are good, but
Yeah.
it's when they're not that you find out, do I really want to go to war with this person?
It's how like relationships and conviction, just whether it's stocks or relationships, it just takes time.
Yeah.
And like I still feel like the biggest asset to any stock picker that's a long only quality focused stock picker is the relationships you build up over time with your colleagues, with CEOs, with other investors. Um, that's the biggest asset. I mean, and the end game there is finally me after doing this for 20 years. I couldn't have supercharged it any quicker, because you just need that time to share those experiences with everybody in that network so they can see who you truly are and that you can see who they are, where
Yeah.
you can allow them to take too much from you to see who they really are, and that's okay. How where they stand,
Yeah.
and vice versa. So it's like it just takes time to go through that. And like from just a purely investment standpoint, sort of I think the thing that makes you feel the proudest is after a decade or 2 decades to where you're the first call,
Yeah.
whether it's a CEO that wants to do it again or an investor that's a good colleague of yours, like where you're the first call. They see so much value in you because of what you provide with them over the years. They appreciate you so much that you're the first call,
Yeah.
and that's when it gets cool, like that feedback loop. And that's just makes you want to do it more, just be that person that you want to befriend and have a relationship with,
Yeah.
just to keep that flywheel going.
Yeah, I like that. I like that a lot. It's funny. Somebody asked me, they're like, what are you trying to accomplish out of the podcast? I was like, if you listen, I think you can probably piece together that I've accomplished most of what I tried to accomplish. Like, it's a pretty good network I built up. And, I think on average, it's a group of people that I stay in contact with and we talk, and it's like super fun.
Yeah.
It's funny. I used to think I wanted it to be like some big show. Now I actually could care less, which probably means there's a chance it gets bigger than I want it to.
And that's how it was with MicroCapClub too. When I started in 2011, that site was costing me 20 grand a year. I was a full-time private investor. And, there was no monetization of it. That didn't happen until 6 years later. It was me mainly talking to myself in a private forum.
Yeah.
It was a lonely place. And I was like, well,
Ian, why are you paying $20,000 to talk to
yeah,
yourself on the internet? Don't bother me.
yeah, I know. Just don't worry about it. Well, it's like I always believe in like at least having a professional, like the
Yeah.
outward face of it.
Yeah.
Like make yourself look more professional than what you really
Yeah,
are.
that's right. I'm the
And so that
founder of
that's how I,
MicroCapClub. Well, what is that? It's
yeah,
me talking to myself behind a paywall. Shut up.
exactly. It's me in my echo chamber, pay up.
I like it.
But it took a solid 6 or 7 years, for it to even turn into anything.
Yeah.
And now after 12 years, it's really cool what it's become, and it could have never became that way unless I didn't care from the beginning to not monetize it.
Yeah.
You know, so
You
yeah,
know who else has built a really good community is John Mihalkovich at Manual of Ideas. I really I admire what he's done, and I like how he's pivoted. I used to get the he used to send out a paper book, and I miss the paper book. John, if you're listening to this, paper books. But he's got like an email thing going on now that's really good, and the conferences that he puts together are great. It's I don't know. It's really fun to see people build communities around them, and I think like microcap club and manual of ideas are two that when I think about the vision for whatever it is that I'm building, that they resonate very very strongly with where I think I want this all to go.
I think very highly of John as well. I think what he's built is incredible, and I think to your point, I can tell you're in a good spot, Bill, just because so many people look at what other people are doing or achieving or accomplishing, and they just get jealous or envious or whatever you want to call it. And you're in a good spot yourself when you can genuinely look at somebody else that's achieving something and feel good for them.
Yeah,
Where you don't have that. You don't have that. Well, vindictive nature to it. Like, well, they don't deserve that, or I could have done that. Whether it's in the business side or an investing side, to where people look at like Nick Sleep, and they held Berkshire, Costco, and Amazon for 13 years, crushed the market by 800%. And people look at it and be like, "Well, I could have done that." Well, you didn't.
yeah,
You
that's
know,
right.
you didn't. You didn't hold those stocks for 13 years and crush the market by 800%.
And what does your current
So
portfolio look like? Right? Like, are you
exactly,
trying
yeah,
to do
yeah,
it? Or are you just talking
right,
shit?
yep,
Yeah.
yeah,
I tell you, man, watching my grandma pass away, I mean, she hasn't passed away yet, but watching her go through the decline, it's just really put a lot of stuff in perspective. I don't know. I've really, part of why I'm stepping back from Value After Hours a little bit is I wrote to Toby and Jake and I said, at this stage, I feel like it almost introduces, because I get kind of like angry at times and it's unfair, but I do. I get like frustrated with the same conversation. And I said, like, I think it's got downside risk to our friendship, which is like the most important thing to me. And two, like, I don't even know why I'm doing it. Like some of this is like attention seeking. And I'm kind of past all that. And I really think, I just really think watching her age and watching my kids grow up simultaneously, kind of like the juxtaposition of those things, it's just kind of got my, I don't know, it's got my head focused, I think, in the right areas. It's funny because I shared some of the, I tweet sometimes, and sometimes I'm a little intoxicated when I do, but some people are like, "Are you having a midlife crisis?" I'm like, actually, I think I'm like getting things in perspective here. I think that's what's really going on.
yeah, yeah. I mean, life's all about becoming less selfish. When you're only now when I look back before I was married, you realize how much time you had.
Yeah.
And it doesn't mean you wasted that time, but it's just then when you get married, you obviously have to devote time and effort to the marriage. And then when you have kids, you have to devote time and effort to the marriage and kids. And so you just have less time to do the other things. And so you just have to force yourself to be more efficient and focused on the things you would accomplish outside the family so it doesn't destroy the family. So
Yeah.
it's just all that balancing act of that is hard, and everybody goes through it. And that's kind of the good thing about it, is not that misery loves company, but we're all going through the same battles, man.
Yeah.
So it's on every level.
Yeah, that's right. Yeah, I think I was neglecting a lot of the stuff that really matters, chasing some stuff that really doesn't. And,
Yeah.
I'm hopefully that's the correct assessment, and hopefully it's over. But pivot as life goes on.
Yeah.
Well, that was heavy.
That's all right. That's
Yeah. Thank you. It's my therapy for the week. Well, man, I don't know. I'm glad you came on to chat. Thank you. And I'm really glad that we've stayed in touch. You're somebody that I love talking to. Every time we chat or whatever on the interwebs, I smile a little. So thanks for coming back on the show, and thanks for staying in touch.
No, thanks for the invite, and I look forward to you hosting a golf event at some point. And then we can throw down.
You and me both, man. You and me both. I don't know. I thought it was going to be April. I had somebody that was helping me, and by helping, I mean that we completely dropped the ball on that. So hopefully in the fall.
Some of the best reads are, you probably read this one.
Yeah.
As well.
Yeah.
I read this like 3 times. I just pulled out, started reading again, or the Elements of Scoring with Raymond Floyd. Like, these are amazing books about golf that are amazing books about investing.
Yes.
And so for you and I that are golfers that like to invest, there's huge lessons in these golfing books just about that are very applicable to investing. You can kill 2 birds with 1 stone by reading them.
Yeah.
You learn a little about golf and investing.
Dude, the thing about golf that I think is so applicable to life is, like, it is so easy to ruin your round on any given hole, and it's so hard to get back unforced errors. And I don't care if that's a diet, I don't care if it's a relationship that you're in. Like, you go off the handle or do something really wrong to somebody, and like, it takes years to come back from that. And and also, you got to be compassionate with people and understand they're going to make mistakes, and life isn't a game of perfect. But I don't know. I the older I get, the more I understand the saying golf is life.
Yeah. Well, and it's also, one of the main, one of the other correlations is just the mental aspect of golf. It's same as investing, and just like you said, forgetting the bad shots, and just thinking about the shot you're playing. A lot of people look at deliberate practice, and that idea of deliberate practice, and it's very applicable to sports, and really it's just the idea of, practicing, getting immediate feedback from a coach, repetition, experience, just doing that over and over and over again. It's like the 10,000 hour thing.
Yeah.
All that stuff built into one, and people try to apply that to investing as well. The difference with investing, though, is just the feedback loops are so much longer.
Yep.
It's like you and I go out and hit a bad shot. Like, okay, we hit a bad shot, we can hit the next one immediately.
Yeah, that's right.
We go out, we play a bad note on the guitar or piano, whichever note I would play would be bad because I don't play either one. But like to
you get an immediate, your ear tells you messed that up, right?
Yes.
Yeah.
But with investing, it's like you might not know you're wrong for 3 months, 3 years, or whatever. And then even if you're right, you might be right for the wrong reason.
Well, I've owned cable for 5 years. I still don't know if I was right or wrong, or if I'm right or wrong. I mean, we'll see.
Yeah. Yeah. So I think that's what makes it different and harder with investing, is because you don't have the immediate feedback loops to what you did was wrong.
Yeah.
And only retroactively, probably for 10 years looking back, you realize, oh, that was dumb. And you don't want to waste your whole life knowing that you were doing something dumb for a few years,
Yeah.
Like it kills you mentally,
Yeah.
But
yeah, I think the other thing is there are mistakes along the journey, but like that doesn't, I don't know, you got to just keep playing,
Yeah. Yep.
And not take it to the, the next tee or whatever, to the next idea. And conversely, like when things go really well, I think I could have used to remind myself in this in 2021 a little bit more, but to not get too, amped up that they're going well, and to not kind of buy my own bullshit would have gone a little bit further. But whatever. That's how bubbles are.
Yeah, and I think it's probably golf is, especially the way I play golf with, which I'm probably a 15 handicap now. I used to be like a 7, but is I know I'm going to hit bad shots, and it's the same thing with microcap investing, where I know I'm going to be wrong with some of these things. It doesn't matter if it checked all the right check boxes or the right frameworks are in place. There's still 30-40% chance that I'm wrong, and wrong can mean I lose money or make money, but I know I'm going to be wrong. And not being bogged down in making a decision, trying to be perfect.
Yeah.
Trying to find the perfect situation, because a lot of these small emerging companies, none of them are perfect. In fact, the bet that you're making is that, they can fix some of the hair that you see on them over time. And you're just going to be right or wrong. I mean, even on a portfolio level, we're in like 6 companies, but, we added 8 in 2022 and we took all of them off by year end.
Huh.
And I think it's important to not be afraid to take small positions and grow with them over time. And some years you're not going to add any real meaningful positions, and other times you'll find that one every 2 or 3 years where you can belly up the bar on.
Yeah.
But you can't be afraid to pull the trigger, because oftentimes, like, you don't get to know the management team or the business until you own it. The management team treats you differently when they know you own the business. And so I'm not being afraid to buy a little bit and look wrong. And it's just part of the way my strategy is, having some small positions, taking them on and off, being okay if that was a 1 or 2% net drag in the portfolio. That's the price of progress.
Yeah. Yeah, that makes sense. With microcap or something illiquid, the thing that's tough is when you're wrong. How do you get out of it? Like, do you blow out of it, move the stock, or do you just kind of like trickle out? Because you don't want to stay in something that's wrong, but you also don't want to, like, I don't know, give it away, right?
Yeah. Well, I think it's just, too, it's about, it's where Jake's tool comes in, just journaling about this stuff too. Like, we were even quantifying out how wrong you are. Like, last year, we were wrong probably a net 24% drag in the portfolio. We're always going to have losers in our portfolio. We're always going to have things we're going to lose money on, but there's a difference between losers and mistakes.
Yeah.
Mistakes are the things that bug me, because that is taking a loser and making it worse because of you acting or not acting on that situation. And so when you look at it, like, even quantitatively, it's like, okay, our losers were a net 24% drag in the portfolio, but my mistakes were half of that. Like, that's not something I'm okay with.
Yeah.
Being self-aware enough to identify that those were on you, not the market or not even the situation. That was additional detraction that you yourself and put on the portfolio and your investors, and being honest with them and yourself about it and trying to get better over time.
Yeah. Interesting. I like that. Yeah. I mean, I think if you're not thinking about things like that, then it's impossible to get better, right?
Yeah.
Yeah. Cool.
Yeah.
Well, thank you very much, man. I appreciate your time. I'm going to follow up with you to pay you so that I can attend the event that you will be throwing and help you cover your costs. And I'm super amped to meet those guys. That'll be good. It's
going to be an amazing event. It's probably the one I've been most excited about in a long time.
That's cool.
I'm excited about it. Yeah, I hope you can make it out.
Oh, I'll make it. I mean, I love to party in Schaumburg. Who doesn't? Is it in Schaumburg?
Yeah, exactly. It's I think it's just south. Was it Tasca?
All right. Yeah. Same diff.
Yeah, somewhere
Same
around
diff.
there. Yeah.
All right. Yeah. We'll be around O'Hare, raging it up.
In a second-rate Westin hotel.
That's right. As hotels around that area are. But it'll be fun.
All right, man.
All right, man. Have a good one. Thank you very much.
Thank you.
But it's absolutely necessary. But it's absolutely necessary.